Hey guys, it's Kyrill Asatur with Centerfin Capital, and this is our Centerfin Collective Weekly for the week ending April 12th, 2024. As always, we'd like to highlight a handful of things to bring to your attention as it relates to markets and investing. This week, we will discuss inflation. It was a big theme for the week. We had a hotter than expected print in CPI on Wednesday. Second, we will discuss gold, which is related to inflation. It reached new all-time highs yet again, reaching $2,400 an ounce for the first time. And we'll discuss what that means and why potentially it's happening. And then last but not least, we'll discuss the latest narrative change around AI, which is not really news this week, but the discussion about the energy usage of these new generative AI technologies have come to the fore, and we wanted to highlight it. First, CPI. CPI is the Consumer Price Index. It basically measures a basket of goods and services that consumers experience, and it's the government's way of figuring out what the inflationary picture looks like. It came in at 3.5% year over year, 0.4% month over month. Both of those readings were significantly higher than expected. I shouldn't say significantly, they were 0.1% higher than expected, but still it was the third month where they were higher than expected in a row. We don't think the number in itself is that important, except for the fact that the trend in inflation has stopped going down. Inflation has been at kind of these levels bouncing around, somewhere in the 3.5 range since last fall. And we think that's generally a negative thing. The other thing to highlight about this inflation reading was that it was very broad. We saw shelter as a big input, auto insurance. We also saw medical services, hospitals, apparel, and transportation were all hotter than expected. It's broad-based inflation, which is not a great sign. The odds of a rate cut for June dropped from about 60% last week to 20% on the back of this number. And the 10-year yield rose over 4.6% for the first time this year. As you recall, last year, as the 10-year yield rose above close to 5%, the stock market took about a 10% drawdown. So the market does not like higher long-end bond yields, and bond yields have gone up because of this. One interesting thing to highlight, which came out of JP Morgan this week, was there's an economist that put out a paper arguing that the higher rates are actually inflationary. His reasoning is around shelter. The CPI uses a calculation called the owner's equivalent rent, which is effectively a number they come up with that gives them a reading of both renting and home ownership. And that's a big part of, obviously, people's use of their funds, so it's a big part of the CPI. And his argument around how higher rates could be inflationary in that part of the CPI is because, if you think about it, higher rates have made mortgage rates high, and hence it's less affordable to be able to buy homes, so more people are renting. So it's put pressure on rent prices to be higher, and it's decreased price discovery in the housing market because people that may want to sell can't really sell because then they can't buy at the higher mortgage rate, and people that want to buy can't afford to buy because prices have been high over the last couple of years, and mortgage rates are high. And so it's an interesting thing. It's been talked about in the fringe of the market, but it's never been brought to the fore by somebody like JP Morgan. So we thought we'd highlight it for you guys. The second, we'll talk about gold. So gold traded above $2,400 an ounce on Friday morning, actually. And it's now over 16% for the year. It's outperforming. Stocks and bonds are actually down on the year. Stocks are up somewhere in the neighborhood of 8% so far this year. It's very unusual for gold to be trading as strongly as it has, with the US dollar also stronger and interest rates and bond yields going up. It's a very interesting indicator. I think it's telling us something. The demand, as we've talked about before, has come from central banks. So central banks have been big buyers of physical gold. That is an indication of them diversifying their reserves potentially out of US dollars. So it's an indication of how other countries are viewing the US dollar as the current global reserve currency. By buying gold, they're diversifying away from it. There's also been physical demand by individuals. Costco reported this week, actually, that they're selling $200 million of physical gold a month, which is quite interesting. People buy physical gold because it is a protection against inflation. We decoupled from gold in the US dollar in the early 1970s, and ever since then, the value of the US dollar has dropped significantly, and the gold price has gone up. The other obvious use case for gold is it's the ultimate kind of fear trade. The geopolitical situation right now has been the worst it's ever been. Iran this week actually threatened to retaliate against the attacks Israel made on their embassy in Syria, and I'm sure that's not helping things. So I think gold is sniffing out some whether it be inflation or some sort of escalation in geopolitical environment. But it's definitely notable, and it's crazy to see it trade the way it has this year. And last but not least, the latest narrative around AI, and we were reminded of this because the CEO of ARM was speaking about this, and he highlighted the fact that the energy usage for powering the chips that power generative AI models is significant. These chips, these models, as we've discussed, are powered by GPUs. The biggest maker of these GPUs is obviously NVIDIA. These GPUs sit at server farms, data centers, and they use a lot of power. And by his estimate, and we've seen various estimates, but by his estimate, he thinks that generative AI can consume 20 to 25% of all of electricity in the US by the end of the decade. We saw another study from Boston Consulting Group that said it would be closer to 7.5 to 10% of all of electricity. Either way, it's multiples of what it is today. I think it's estimated that last year it was about 2.5% of all of our electricity demand. Now, this is going to put pressure on the electricity grid, which already has pressure on it because we've been moving into this electric vehicle world, and it's going to be a counterbalance to the natural deflationary forces of technology because likely will be inflationary for energy prices. It's something we wanted to bring to your attention. It's been talked about by Elon Musk over the last couple of months, and like I said, the CEO of ARM brought it up this week, and it brought it back to our attention, and so we wanted to highlight it for you. That's all for this week. As always, reach out to us if you'd like to discuss any of this in more detail, and have a great weekend.